Live.
We are live, right?
We are live now.
Good morning, everyone. Developing a comprehensive pitching plan and checklist is essential for securing angel and venture capital investments. This strategic approach ensures that all key aspects of the business proposal are effectively communicated and aligned with the investor's interest. The plan outlines a structured presentation while the checklist serves as a meticulous guide, guaranteeing no crucial detail goes unnoticed during these crucial interactions. This preparation significantly enhances the chances of capturing the attention and support of potential investors. To discuss the topic of preparing pitching plan and checklist for the angel and VC investment, we are having our expert speaker, Dr. Moitri Goswami. She is a Business World 40 Under 40 awardee and CEO of Jucate, a tech company, WebTechie, Mars Tech company, and Lonerpreneur entrepreneur community. She is the state president at Maharashtra STEM Education Council and mentors startup at CII Center of Excellence for Innovation, Entrepreneurship and Startups, CIES, India Accelerator, Gurgaon, DSU Innovation and Incubation Center for Entrepreneurship, and RDNC IIC Mumbai. She is also awarded with the DMA Tribilizer CMO Award by a distinguished jury led by Sam Balsara of Madison, an Exceptional Women of Excellence Award from the Women Economic Forum and prestigious Indian Achievers Award. Welcome, ma'am. Over to you to discuss and share insightful words with our innovators community. Also, I will request all viewers to kindly share your questions so that we can take it at the end of this meeting.
Thank you so much, Abhishek ji, for that lovely introduction. So without wasting any time, let me take this session forward and share. Can you see it all?
Yes, yes, your voice is audible.
And the screen is also visible, right?
Yes, yes, yes. We can.
Okay. So let's start the session for the day. So let's begin with the topic preparing pitching plan and checklist for angel and VC investment. So any startup in their entire life would definitely go for angel or VC investment. Most startups do go for it. And today I'll tell you the basic plan that you require to pitch to an angel or a VC. Now VC comes at a later stage, angel comes before VCs, and the pitch differs a little bit in terms of financials. Whatever you present to the angel investor and whatever you present to the VC is a little different because you are pitching to a VC at a later stage, but the broader plan remains the same, and that is what we are going to discuss about. Without I cannot cover the entire nitty-gritties about the difference between pitching to an angel and pitching to a VC, but that is going to take a lot of time. But we'll keep in mind the broader plan that we need to actually pitch, keep in mind when we are pitching to an investor. So we'll cover two things today. One is the pitch basics and a little bit of investment basics so as to understand what exactly is going around in the investment scenario and what exactly is the difference between an angel and a VC, since you all are early stage startups and it is important to distinguish between the two, and who should you be talking to at what stage of your life cycle in a startup. So let me start with the pitch basics first. So we'll talk about the building blocks. So basically, pitch. What is a pitch deck basically? So pitch deck is a basically a presentation. It's a compilation of slides that you actually present to an investor, whether you are presenting it live or whether you are sending via email. And it is the key thing that helps you secure funds for growing your business. It's a brief presentation that basically tells about your business plan, some metrics, and what exactly is your vision when you are talking about your startup, where do you want it to go, what would it look like in years to come, say for 5 years, in the next 5 years. And most of the investors would like to see a broader vision, that a startup is scalable, you are able to do good business, and what kind of numbers are you showing to the investors is something that's important. So when you are thinking from an investor perspective, don't think in a narrow mindset, broaden your horizons and talk about the numbers, talk about big numbers. Otherwise the investors don't get interested. If you are not showing good returns, if you are not showing good profitability, at least the numbers are not there, then they are not interested. So it's like compiling something very attractive and grabbing the attention of the investor at the same time. And you need to include all information, including your goals, your methodology. And at the same time, it has to be very interesting, because most of the pitch decks we have seen till now are like very boring. Sometimes they are very boring, and it's like at the midway only you lose interest. So that is something you should not be doing. So you need to make it attractive so that the investor reads it till the end. And even if you are presenting, if they are actually listening to you the entire duration. Now, by rule pitch deck, there are 3 key rules. So there is a person by the name Guy Kawasaki who has given this, and that rule is known as 10, 20, 30. So an ideal pitch deck would have 10 slides. That's where the 10 comes in. 20 means you present it for 20 minutes. Beyond 20 minutes, it becomes boring and no one wants to listen to you. So you should always stick to those 20 minutes. These days, people don't even listen to pitch decks for 20 minutes. So you should be grabbing the attention of the investor within the first 2-3 minutes itself, even within the first half minute itself. And 30 means what is the font size that you need to keep in your deck. Now, it's a variable number. Sometimes pitches could be as long as say 20 slides or 25 slides, but the ideal number to stick to is 10, because beyond that it becomes difficult to present. And most of the places where you are going to pitch, say pitch competitions, they are going to give you a very limited amount of time, like 10 to 15 minutes. And even if you are sending your pitch deck across to investors, then also they are going to devote a very limited amount of time. So try to grab the entire information in a gist, in a nutshell, within those 10 slides. And you need to keep those 10, 20, 30 rule in your mind whenever you are preparing a pitch deck. Now, what are the basics of a pitch deck? So you have to think forward while you are designing your pitch deck. Don't think narrow. Do beautiful designs. If you can't do it, get it done from a professional agency, because that is going to talk about your startup at the first place. Because whenever you are not there, then your pitch is talking about your startup. So do a thoughtful deck, prepare the content wisely, take time, devote time while you are preparing for a pitch deck, and always present it before you are actually presenting it to an investor. Always do mock presentations, always see what exactly are you missing, to keep on presenting your deck to say your mentors, your advisors, and see wherever you are faltering and try to correct it. The next thing is to be comprehensive. So you should always be ready with all the questions, and because a lot of information will not get covered within your 10 slides or 15 slides, whatever you are presenting to the investor. So it's important that you always prepare for answers, so that whatever your potential investors ask you, especially the numbers, you should always remember them, by heart them, remember them, and talk about numbers very well, because that is where most of the founders falter. Next thing is to keep it engaging. So if you are very heavy on tech, or you have got a lot of information to put into your pitch deck, then please break up those slides and try to make the slide illustrative enough. Don't put too much text onto it so that people have to read a lot and they don't understand what you are talking about. Though most people do not have that much of time to talk to you, so it's important that you keep it straightforward, keep it simple, and keep it in a more of a visual representation, because most of the times people grab that visual thing very well. The next is to keep it straightforward. So pare down means cut it short to only those many slides which are easier to understand. Don't make it difficult to understand for people. Many a times investor will not belong to the sector from in which you are working, in which your startup is working, and they won't sometimes don't understand the technology as well. So it is important that you keep it easier to understand, so that they understand what exactly are you trying to do in your startup. It should not be very jargon heavy, it should not be very tech heavy, it should not be talking about too much technicalities. It should be presented in such a way that people understand, that the investors understand what exactly are you trying to talk about in your. They should basically be able to take out that business idea from your pitch deck. So the first slide that you need to put in your pitch deck is the overview. So overview is like an elevator pitch. If you all know what an elevator pitch is like, it's like talking about your startup idea within the first 2 minutes. If all of you have seen what happens in Shark Tank, in the Indian one and the US one, then you must have seen what an elevator pitch looks like. Elevator pitch is a very short statement which talks about your startup, your vision, your goals in a very concise statement. And it also talks about your numbers, what are you targeting. It's a very concise statement. So it's basically a very high level overview of your product and service. And with this statement, the person should be able to understand what exactly is your startup going to do, and what is your startup going to achieve. What is your startup going to do, what kind of business is it going to do, who is it going to serve, is something that should be clear in the first slide itself. And it mustn't be more than 50 words. It's like what used to be the Twitter pitch, that only that much length should be put into the overview slide. So it should talk about who are you, why you are here, keep it very short. Don't put too much text. Create a hook. Why should actually be people listening to you? Because this is the point where investors either get interested or they just drop out. So this is the slide where you have to put in your maximum effort, and it should talk about exactly what your startup want to do in a very, very engaging way. The next slide should talk about team. Most investors, more than investing in an idea, they invest in the team. So that's why we always say put the team first. A lot of decks would advise you to put the team at the last, but we always advise people to put the team at the beginning itself, because most of the start investors actually invest the people in the people who are behind the idea. And it is important to show who's actually the team going to be. And it's a very important thing. I mean, a lot of people would tell you that team is not important, but trust me, when you are doing a startup, a team is very important. You cannot do all and everything by yourself. So put a team together, put who are behind the idea, briefly describe their role, talk about your founders, talk about who are the key team members going to be, who are the advisors going to be, who are the mentors going to be, if you have them at all. Keeping these people actually builds trust in the mind of the investor. Then is to talk about the history of the team member. In case you do not have any history, then talk about something interesting about your team. Why exactly have they gathered together, or why is this idea so important for them. Then talk about your educational background, whatever is your expertise. If you do not have any job experience, it's well and good. Just talk about what exactly are you doing, and what exactly is your motivation behind doing this startup. Then describe the specific role of each person in the company. And also you talk about what each person is going to bring in the company. Now it's important to have a complementary team. So you doing the same thing and three other people doing the same thing is not what is appreciated by investors. So try to gather a complementary team, and also talk about your passion. Why is it so important for you to work on this idea, and why did you decide to work for a startup? Tell about your story. And not every uh, the entire thing should revolve around a story. Build a story. Why have you gathered together? Why are you working on this idea? Something that you need to bring out in this slide. Then talk about the problem. So every startup revolves around a problem. You see a problem, and that's why you are solving it, right? So you have to talk about the problem, and always tell them a big problem, big enough and not that big enough that you have to build a massive solution. Talk about a manageable problem. What problem are you trying to solve? And always analyze whether it is really a problem or it's a it's just a problem that has been created by you and it does not exist in your audience. So while doing this slide, it's important to talk to some potential customers as well to know whether the problem really exists, because this is a maker or breaker for a startup. So you need to solve a real problem. So here in this slide, you need to talk about customer pain points. What exactly is your customer experiencing? What pain do they have? Then you create a story around what your customers are facing, and this story has to be relatable. Investors must be able to relate to this story. Now you talk about what kind of people are you building this product for, and this kind of person thing is known as persona. What kind of age group are you targeting? What geography are you targeting? What literacy levels, what social status, what economic status? You need to talk about everything here. So that particular thing about your, which describes your audience, is known as persona. So you have to define a persona. What are their typical problems? What is their typical life like? So this is something that you have to build here. So everything in itself is a very big topic. I can keep on talking on and on, but it's like start doing some research around these topics and you would understand what I'm talking about. So persona is important when you're talking about the problem. Then you talk about how your startup is approaching this problem and what are the key elements going to be. So this is what Uber Cabs actually presented in their first deck. This was their problem statement. Like, so this, they said that most use aging and inefficient technology, radio dispatch, no two-way communication, most common car Ford Crown Victoria. So this is something that they were talking about, the cap scenario in US in 2008, and this is how they presented their problems. You can relate instantly that these are the problems you also face, and this is a very solvable problem, and this is a potential idea that can be actually invested onto. So this is something that you have to build in a very nice way so that people understand what exactly are you talking about and your investors can relate to that actual problem. Next thing that you talk about is your solution. Now that you have talked about the problem, you now talk about how are you planning to solve that problem. So here you talk about what exactly is your startup going to do, how are you going to approach the problem. Here you can also talk about some proprietary technology, if you are going to use something at all, or whatever is your solution going to be, how are you going to actually solve the problem is something that you talk about here. And you can also cover some basic product features, talk about why it's compelling. There must be other solutions to the same problem, right? So you have to tell the investor why is your solution compelling vis-a-vis other competitors that already exist in the market. Then you can also talk about some current industry solutions who are already providing solutions to that particular problem, and you talk about the gaps where your startup comes in and fills those gaps, because since the solutions are not good enough in the existing market, that's why your startup is trying to actually fill in those gaps. And you can include some explainer videos, demos, products, screenshots if you at all you have. And if you don't have, then you can create some mock-ups to show the investors what your product is exactly going to do for the consumers. So this is a solution slide that was presented. These are all first pitch decks presented by heavily invested and successful startups across the world. So I have tried to capture their first deck only because that is where you guys are at this stage currently. So this is the solution that was proposed by Intercom. You can go through how they have actually presented their solution. This deck will be available with you at a later stage in time. So you can always see how they have presented their solution in a very beautiful and a simple way so that everyone understands. The investor also understands what exactly are they trying to do. So I have put example slides for every slide deck that should be present in the pitch deck. The next slide has to be your market validation. So market validation shows proof that people are actually willing to purchase your product. And this is very important because unless and until you have actual users who are willing to buy your product, your startup is not going to make any money. So it's important to investors, and it's important to always show that you have a market for your product, and it's always important to show that those proofs that you have done the research and you have talked to potential customers and they're ready to pay you something. Unless and until you have that proof, no investor is going to be actually interested in your startup. So here you can actually present your current sales if you have done something, and if you haven't done any sales, then you can talk about your competitors and how they are doing sales in the same segment, and that gives a validation of the market, because people are paying your competitors, and if you offer a better solution, they are going to pay you too. So not always a startup is at that stage where they are doing revenues. So you can always talk about your competitors who are already doing sales in that segment, and you can talk about those numbers. And here you have to target about you have to talk about your target market. Who are you targeting? That specific market where you are going to place your product, what their purchasing power is going to be like. I mean, how much are they willing to pay you? How much are they actually going to pay for the same service, and what kind of habits do they have um, vis-a-vis your industry which you are targeting. And this is very important because not every investor would be familiar with every sector, every industry, every product. So it's important to talk about market validation so that they understand that there are actual people in out in the market who are going to pay you. So this is LinkedIn's first deck. This is the Series B deck, in which they actually were going to launch their LinkedIn ads. So that's when they talked about other players in the market like Google, who were already doing AdWords, then PayPal, which was already doing ads, then eBay, which was already doing ads, and how were they monetizing. This is the Series B deck of LinkedIn that they presented to the investors when they actually launched their ad platform. So they took money for that because they had not launched themselves. So they talked about other players in the market who are making money out of ads. Next slide to talk about is your market opportunity. Market opportunity is basically the total market that's available for your product. Even if you don't know the exact size of the market, it's important to predict the size of the market, because your target market should be large enough. It should not be in very meager numbers that the investor doesn't get interested in. A lot of times people come with hardly some 100,000 people ready to buy my product, but that is not something investors are interested in. So you need to talk about a bigger market. And the most important thing to talk about in this slide is to address the TAM, SAM, and target market. TAM is the total addressable market. Total addressable market means the entire market. If that's available to you, then what is the size of that market? Supposedly, if you achieve 100% of market share, then what is the size of that market? So most of the TAM data would be available from secondary research. You need to find it out from the internet. A lot of times the data would be available from through secondary research only. The next thing to talk about is the addressable market. So that segment of the TAM which your product or service is going to target, and these would be based on a lot of things like what is your geographical outreach going to be, whether you're going to place your product within India, whether you are going to target outside India, European market or the US market. So that based on that you calculate your SAM, and this SAM number has to be calculated pretty nicely so that people actually believe in you, and it has to be calculated based on how whether you have the channels to reach those markets, whether you can actually reach the US market or European market based on your potential to reach out wherever you can. If you don't have a market in India, then there's no point targeting India, right? So you have to calculate the SAM properly, keeping an understanding of what exactly is your persona going to be and who are you going to actually target, where in the world are you going to target your product to. And the third thing to talk about is the target market. So basically target market is that portion of the SAM which you can actually capture, and it will depend on a lot of things like uh, who are the competitors, what kind of funds are available with you, what kind of team strength do you have, how many team members do you have. So you have to actually calculate this based on your potential, how can you reach that portion of the SAM, and how are you going to capture it. So it's important to also keep in mind the amount of funds available with you, and based on your target market also you can actually determine the amount of funding you are going to ask from your investors, because a lot of money that investors actually pump in into a startup goes into marketing. So this push calculating this part is very critical, because a lot of money, say 40-50% of whatever you get from your investor does go into marketing. So it's important to calculate the target market in a very in a proper way, and also tell the investor how are you going to approach the target market is something very important when you are addressing this slide. So this is the first deck that Airbnb presented. So they calculated the TAM, if you see, 2 billion trips based on the data available from Internet Travel Industry Association of America and World Tourism Organization. Then how did they arrive at SAM 560 million? And then how much was their share of market going to be? That is 15% of the total available market. So that is how they calculated. This is something that you have to do. These calculations have to go on when you are talking to an investor. The next thing to talk about is your product. Now, product is slightly different from the solution. Solution is a generic slide as to how your startup is going to approach the problem. The product talks in nitty-gritty about what exactly is your startup going to do. So here you actually talk about your industry and tell the investors how your product is going to help solve the problem in the industry. You talk about the value proposition, the actual value that your startup, your product is going to bring into the market, and the impact that it is going to create. So it is important to talk about value proposition here, because most of the funding happens apart from what your team does, apart from the problem, apart from the solution. The value proposition is very important thing when your product is actually being displayed to the investors. And you also need to talk about the impact that you are going to create, and this impact has to be a larger impact, not a very uh, myopic kind of an impact, but a broader vision that you have to talk about. Here you can also include POCs, proof of concepts, if you have done one with your customers. And it is always advisable to do POCs before you are actually approaching investors, because in India, most of the startups don't get funded at a pen and paper stage. You have to have revenues, you have to have actual customers. Even if you are not doing good revenues, you need to have a considerable size of traction when you are talking to your investors. So it's important that you have a POC here, even you have not made real money in your startup. And it's important to include testimonials of actual customers, because most of the time when your investor likes your product and investor likes your startup, they will do due diligence. They'll call the customer, they'll call some of the customers of your startup, and they'll find out what exactly are the customers talking about your product. So it's important to have some actual testimonials and be straightforward, true about it, because the due diligence team will eventually find out if you're lying at this point. So this is the product slide of Dropbox that they presented in their first pitch deck. So this is something, what I said about, they are talking about the value proposition, they are talking about the impact, the bigger picture that they are going to create. You need to address the product slide in a similar fashion. The next thing to talk about is competitive landscape. So what alternative solutions are there to the problem that you are trying to solve? So here you are trying to establish your position vis-a-vis your competitors. So you need to contextualize your startup when in the market. You need to contextualize your startup against your competitors. Here you need to talk about something about the revenue data, what exactly are the competitors doing in the market. What the competitors do well is something that you need to talk about, and not always do you talk about talk saying that the competitors are doing everything bad. That is not possible. So you have to be very honest here. Whatever they are doing good is something that you have to tell, and whatever they are not doing well is also something that you have to tell. And you have to tell that, yeah, vis-a-vis my competitor, these are the things that I'm going to do better than my competitor. Then talk about what sets you apart, and also talk about how your startup bridges those product gaps that are already there in the market. So competitive landscape is not talking bad about your competitors. It is just establishing your position against your competitors, so that you are proven, you have a supremacy over your competitors, but you don't show them in bad light or bad picture, because no one can exist alone in the market. You are always going to have competitors in the market. So it is not advisable to show your competitor in a bad light. So don't talk negative things about your competitor. That is something that you need to remember here. Everyone out there is doing business, and we don't talk negative things about what others are doing, what's companies are doing in the same segment. You just have to establish your position. That is something you need to remember, because it's a turn off when people talk negative about their competitors. Here you have to talk about your vision, and also you need to talk something about your IPs or some key partnerships, like you have landed up with a letter of intent with a very big company, or say you have landed into a partnership with a very big company, you have a very good hold of the market, is something that you have to talk about. How is it difficult for your competitor to very easily enter into the market, is something that you have to show. So this is how Mint.com showed their competitors to be. So see, they have not talked negative about their competitor, but they have just said what exactly is the market lacking, and how is Mint going to plug in whatever is lacking in the market. So that is something you have to keep in mind. The next thing you have to talk about is your marketing strategy. Marketing strategy is very important. Telling about the sales pipeline, the marketing funnel is very important. So you have to tell how are you going to get the market share, the target market that you talked about in the previous slide. How are you going to achieve it? That is something you are going to talk about in this. This slide is very important, because it is going to talk about your GTM, go to market, and this slide is also very important, because it is going to tell you how much is it going to cost to actually enter the market, and a lot of funding that you ask from the investor. A lot of figures from marketing costs are actually included in the funding ask. So it is important to determine a proper go to market. How are you going to enter the market? What is your marketing channel going to be? How are you going to build the sales engine? What is the cost of building a sales engine that you are actually planning, that you have actually decided, that you have actually taken into consideration to enter the target market that you have identified? And it will also tell about the investors, how actually is the startup going to sell its product. And this GTM has to be carefully thought about, because a lot of startups focus a lot on the product, but never actually take into consideration how are they going to enter the market. So marketing is something that you have to take into consideration, because even you have built a great product, and you have not marketed it well, then people don't know about you, and you are not going to make money out of that product. So it's important to calculate everything, find out how are you going to get into the market. So this determining the strategy, sitting with people, sitting with advisors, people from your sector, people who are senior in your sector, it's important to talk to them and identify how are you going to get into the market. I'm sorry for the glitch. I don't know what's happening. It goes back again and again. The next thing that you talk about is the business model. So business model basically talks about how are you planning to make money in your startup? What model are you going to take? A lot of models are available in the market. I have listed a few from some of the prominent startups across the world. There are a lot more you can identify, you can find out how you're going to make money. And also you are going to, when you're talking about your business model, you are also going to discuss a schedule on when do you expect your revenues to pour into the startup. So initially, A lot of startups don't make money in the initial phases, but you have to actually show the investor when are you exactly going to make money, because that is very important. If you are not able to show revenues in the near future, then your business does not make sense. So it is very important to have a business model from the beginning itself. So clearly explain how your product is going to make money. Some of the models that are available are commission model, in which Airbnb works. So for every stay that you do at a homestay or whatever stay that they offer, they take a commission. Then there is a freemium model which LinkedIn offers. Now LinkedIn has also another model that is from their ads. Freemium is that the first year product is free, and then there are some premium features for which you are charged. So LinkedIn has a premium profile for which they charge some money. Then you have subscription model, like the one Netflix gives you. So every month you pay some money and then they give you a subscription. You don't pay, the subscription goes off. Marketplace model is like Flipkart. They make money from the marketplace. They earn commission from all the sellers who are actually selling on their platform. So they have enabled the tech for their sellers, and they are taking commission from all the people who are actually enrolled onto Flipkart. So there are a lot of different other models. Research them and find out what works best for your startup. This is the business model of Airbnb. So for every trip, they charge some commission, like 10% on each transaction. So every transaction that happens through Airbnb, they take 10% commission out of that, the total amount. The next thing that you talk about is your traction. So traction is not necessarily only about how much money are you going to make at the end of your business. It can talk about certain KPIs also. It talks about month-on-month growth rate. If you haven't started your business yet, but you have pre-orders, then you can talk about pre-orders. You can talk about letter of intent, that you have got some letter of intent from XYZ country or somewhere you are going to place your product. You can, or some big company from where you have gotten your LOI. So you can talk about those. You can talk about beta signups. Say you are launching an app into the market. You can talk about some beta signups that have already happened before, even before you have launched into the market. You can talk about some licenses that you have got. Say you have landed up with say you have got a tender from the government. You can talk about those, even though that has not put actual money into your startup, but there is an intent of payment at a later point in time. You can talk about that. So not necessarily you need to have always money pouring in into a company, but you need to show that, yeah, money is going to come. And how is it going to come? You need to show that proof. That is something investors are interested in seeing. So these are some of the key metrics that you can talk about in your startup. You can talk about some monthly unique visitors. If you have launched an app or a web portal or whatever, then you can talk about the customer. You can go through this slide in detail. Then you can talk about customer conversion rate. You can talk about bounce rates. You can talk about average order value. What exactly is the revenue coming out? So if you are a manufacturing startup, you can talk about average order values. Then monthly active users is something very important who are going to launch a website or an app. Then you can talk about average revenue per user. This is equally important for manufacturing and service startups. Monthly recurring revenue, this is again very important. So you can pick some of the metrics from here, whatever is relevant to your industry, and you can actually talk about those metrics. And some of the important metrics to talk about is customer acquisition cost, because that is ultimately going to determine whether how much money are you burning acquiring a new customer. So, and that is also going to determine your marketing expenditure, because marketing expenditure is something that gets counted into the investment fund that you get. So it's important to talk about customer acquisitions. Then you talk about lifetime value. Lifetime value is something very important to talk about. These are some of the matrices that all investors want to see in your pitch deck. So the CAC is one, LTV is one, LTV to CAC ratio is one. LTV is the lifetime value. Suppose lifetime value means if suppose a customer today onboards with you, and you think that the customer is going to stay with you for the next 10 years, then you calculate what is the average price they are paying today and how much are they going to pay in the next 10 years. So this is something that you have to calculate specific for your industry. Then, so these are some of the very important key metrics that usually investors take into account, and you can pick some of these and talk about in your pitch deck. This is a reference to a financial model. I mean, how you do the calculations is something that is there in the spreadsheet. Once this pitch deck is available for you, you can go through this and come back to me if you have any doubt. This is a basic financial for a startup in which you can actually do on the calculations and present it to your investors. So it has pretty much everything taken into account. You can go through it, and these are the major things that should be there in your startup pitch deck. The last thing that you talk about is your funding requirement. So what exactly is your requirement like? What have you planned for your startup? How much money are you asking for? And basically, you also have to talk about what do you exactly need it for, at least the broadheads. And it is important to talk about the timeline, and timeline in the sense, how long is the money going to us? So say if you ask for $1 million today, then how long is it going to last? It is advisable to take money for 18 months at least, so that you have a window period for the next round of investment. So whenever you are planning your funding requirement, plan it for the first 18 months, for the next 18 months, so that you have time period to actually do your business also and raise the next round, because raising a round requires somewhere around 6 months. So if you consider the 18 months, then only the first 12 months is something that you would be focusing on your business, and the next 6 months you would be again raising. So 18 months is something that you should always raise from an investor. You can raise higher than 18 months, but it is not advisable to raise an amount that does not last for 18 months. And also talk about what milestones are you going to hit with these funding, the funding that you are going to actually, that you are the funding you are seeking from the investor. So you need to also talk about the milestones, and these milestones are very important, because based on these milestones only, a lot of the money either goes up, the ask either goes up, the ask either goes down. So it is important to plan this requirement very well. If you cannot do it on your own, then sit with a professional, sit with a CA, and plan this in a professional manner, so that the ask doesn't ask at least lasts for 18 months. Now that we have covered the pitch basics, we have talked about what slides go into a pitch deck. We'll talk a little about who are the investors, and what exactly is the difference between an angel and a VC. So basically, investment is something that happens in exchange of ownership. Most of the times it happens in exchange for equity. You give out a percentage of your company, shares of your company, and in exchange of that you get the money, and it is very important to negotiate that percentage well. A lot of people end up giving 50% of their company in the first round itself. So it's important to negotiate, and it's important to understand how much should you be giving out, what should the valuation be like, and what exactly is the investor asking for. Is it worth it to give that much amount of stakes to the investor? This is something that has to be weighed in. A lot of first time founders end up losing a lot of stake in their first round, and they end up not having stake for the next round, and a lot of companies die because of those decisions. So it's important to negotiate with the investors well in the initial stage itself. Let's talk about angel investment. Although the word sounds, very flowery kind of, but and angel investors do fund across the world at pen paper stage, but in India it does not happen at pen paper stage. You need to have revenues, because investors don't take that much amount of risk in India, so the risk capital is low. So It's important to do some amount of business and only then approach an angel investor. They will not invest at day zero of the life cycle of your startup. So it's important to remember that not happens in India. It can happen outside India, but does not happen in India. So angel investors are basically HNIs, high net worth individual people who invest personal funds. So they have got a lot of money and that's why they invest into, and they do it for returns. So you have to be very clear here that angel investors take a lot of return. A lot of money also goes down. I mean, a lot of angel investors do make losses, but the expectation of return is very high when it comes to angel investors. And they will mostly give you money in exchange for equity. There are two types of financing that happens at angel stage in India. One is equity, wherein you take some money and you give out some equity. And there is another mode that is safe notes, recently introduced, was first introduced in the world by Y Combinator, now works in India as well. So safe notes is like, it's a simple agreement for future equity. You do the agreement today, you take some amount of money, but the equity goes to the investor at a later stage in time, and the investor decides when are they going to actually take the equity from the company. It could be during your series B, it could be during your pre-series A, any stage. And this is a very tricky kind of a investment. So if someone is going through safe notes, then please read the document, whatever is being offered to you, and read between the lines, get it evaluated by a professional, because there are a lot of loopholes when it comes to safe notes. The ticket size for an angel investor is less than $10 million in India. And in exchange of 20 to 30% equity, that's the maximum you should shell out from your company during angel investment round. You should not be shelling out anything more than 30%. The team needs to negotiate it really hard so that you don't land up giving out 50% of equity in the first round itself. The return that angel investors expect in the first round is somewhere around 25 to 60%. Sometimes they will ask for 100% also. So be very careful with such kind of investors. Go to professionals who are actually investing. Don't go to some padosi and neighbors who have become rich suddenly and they just want to invest into your startup. Be very careful, because this is the stage most startups die, at the angel investment stage. So angel investors mostly come into pre-revenue stage. Across the world, they do come into pre-revenue stage. In India, you do have to show revenues. And what they evaluate in the startup is the market potential. Then what is the team's ability? Most of the times the investment happens into the team, your traction. Then investor relevance, that's important, because not every investor is going to invest into all sectors. So you have to do that research well, who's investing in your sector and whether they have invested into your competitor. If they have invested into your competitor, they'll not invest in you. So do that research well. Don't waste your time going to an investor who doesn't invest in your sector or has already invested into your competitor. So that is very important. Don't approach every investor. Just do a very good research, do a background research, find out what their portfolio looks like. If you have a competitor sitting in their portfolio, they are not going to invest in you. Then they see some X factor, like you must have seen in Shark Tank, the X factor works. Some of the prominent angel investors in India are Indian Angel Network, one of the most prominent ones. Mumbai Angels is a very prominent one. Chennai Angels is coming up. Then there is Chandigarh Angels, and Venture Catalyst is also a very renowned one. And you can find more. There are a lot of personal HNIs also who are investing, but you need to be very careful when you are approaching people who have just started investing. So going to professionals is the key here. The next is to understand VC. VCs are mostly institutional investors. They are basically limited partner kind of organizations. They have a person, they get funds from bigger organizations. They accumulate that fund and then they start investing into early stage businesses. So most of their investment happens through equity and convertible debt. Convertible debt is something that is a convertible note gets changed into debt at a later stage in time at a fixed rate of interest. So a lot of startups do go for debts also these days. So you can decide what exactly is your requirement. Ticket size would be more than 10 million. And here the equity would be a little lesser than what angel investors ask for, because angel is more riskier than VC. VC comes at a later stage where someone has already taken some risk in your organization. So for them, the risk is lower. So the equity ask is also lower. They have a very feasible return ask, 25 to 40%. Most of them would come at revenue stage only. It could be profitability. Most people don't seek funds in profitability stage, but they would mostly come at pre-profitability revenue stage. They will not come before revenues. What they see is the team. Then they would be, the VCs are mostly interested in your financials. So they would see how are you doing your sales, whether you can be profitable in the near future, what are your product USPs, what kind of markets are you exploring, and have you mostly it would be like expanding into a bigger market, and what kind of scalability are you proposing. Some of the prominent VCs in India right now are Sequoia, Matrix, Kalari, Axel, Nexus Venture, then SAF is there, then Chirate is there. There are a lot of names, but in 2023, these are the ones that are very active. So that's all from my side. Happy to take any questions. And
Thank you so much. Thank you so much for discussing this topic in length and also guiding our innovators community, our faculty members. I think funding is very key aspect, and you have covered um, all aspects very beautifully. One question came from one person. The question is, any tips for defense startup other than IDEX, as licensing are tough challenges here before getting POC at the simulation stage through defense acquisition procedure restrictions on export?
there are a lot of competitions that come up in, I mean, there are a lot of tenders and competitions that get floated in Startup India. So,
Mhm.
I mean, cracking the government is always going to be difficult. So, if you are coming out with a startup idea with government as your only client, then it is going to be a difficult proposition continuing in the market. And frankly, when you go to investors saying that government is your only client, they don't get interested. So, it's important to
True.
find other clients as well. So that is something very important when you are actually coming out with a startup. Although government as a client is very lucrative, but the processes are very difficult. Tendering would be there. Then a lot of due diligence goes on. So you need to find out other clients as well apart from government, because most investors are very skeptical when you propose them that government is your only client. And there are a lot of tenders that get floated on GEM. If you can enroll there, then probably you can see a lot of tenders that get floated for manufacturing startups in the GEM portal. So you can go there and find out.
Okay. My question is to you, and I think you're the part of so many pitching sessions. You are continuously mentoring so many innovators also. And we have seen that how innovators used to pitch their ideas, their startup, especially while deciding how much money they need or they deserve sometime. So, so many innovators are watching this session. When they are reaching out to the VC or such angel investors, what they need to take care while pitching in front of them, because sometime they used to not have a much time to listen, right? So what should be taken care, and especially the challenges and some risk, I think you can mention. uh,
So the first thing we advise people is to network, because once you know the people you are talking to, they are interested in listening to you. You cannot sit at home and talk to an investor, send a pitch deck, because they get a pitch deck every 10-15 minutes and they can't read all the pitch decks, right? So if you are approaching an investor through an email, then it's important to write a very great subject line, so that it interests them and they open the mail first of all. Then it's important to network with investors. If you are sitting at home and taking your product to an investor, then they are not going to talk to you. So it's important to go to certain events where these investors can see you. And also go to mock presentations where the end result is not investment, because at those places a lot of investors sit and they get interested in your idea and they start talking to you. So that is how you can grab the attention of the investors, because the span is very short.
True. One more question is sometimes innovators used to highlight their idea, the
Mhm,
product they are
mhm,
developing,
mhm,
but sometimes they used to miss the future prospect or
mhm,
the team aspect, how they will
mhm,
work on it.
mhm,
Sometime they used to say that my idea is the best idea, but when people used to ask that whether you have done some market research or not.
mhm.
So do you think that all these points are also very relevant, important? If yes, what should be, our priority while pitching any ideas in front of any angel investor or VC?
See, when you are going to an investor, team is important, because no investor in India or abroad, they don't invest in a one person company. So opening OPCs and then LLPs is a myth that they will invest. Frankly, they don't invest. They invest in the team. So it's important to have at least two or three people in the team, at least key players. And these people should be complementary. A lot of people do not focus on building a team, but trust me, team is very important when you are talking to an investor. They know that you alone cannot do all the job. So if you are an engineer, you need to have a marketing person, a person who can talk well, a person who can actually interact with the customer. You can have a salesperson who can actually do sales. Sales is a very difficult task to do. It's the most difficult job, because you have to talk to actual customers and it can be sometimes very intimidating. So it's important to have a very complementary team first. Then second is to talk about your vision. If you cannot talk about what you are going to do in the next 4 or 5 years, and where you see your company, no one is asking you to become Tata or Reliance or Birla or something of that sort, but at least you need to have a bigger vision in picture, because they are after all putting in their money and they need some kind of returns out of that money, right? So it's their hard earned money that they are putting in. So you need to talk about what exactly are you going to do with that money, what exactly do you think about doing with your startup, where do you want it to go, how do you plan it. Some, like Zomato, went into IPO, so a lot of investors benefited out of it. No one thought about it the first day, but at least the founder had that vision that they will reach to that stage, right? So you need to give out that picture so that they can actually think ahead and think forward, and they don't get that impression that their money is going into drains. So some, that is not something that investors want to do. Most of let me tell you frankly, most of the investment, at least 40% of it, goes into losses. They don't make any money out of it. Only 10% or 20% of the investment actually gives them that kind of return. So they want to see the vision, so it needs to get translated into their minds.
Sometimes people used to think that, I'm having good idea and someone should invest it. Do you think that angel investors and VC used to invest their money on idea only?
No one is going to invest in an idea. You need to have a clear picture of who is going to be your customer. And in India, frankly speaking, no one invests in whatever you have written on a piece of paper, because if you go by global facts, then the same idea comes to at least 15 people at the same time. So ideas are not unique, the team executing is going to be unique. And how are you going to executing is how are you going to execute it is going to be the most important thing. So it's important to have some customers. At least you should have done that market research. At least you should have placed the product, because a lot of founders sit at their homes and think that this is a brilliant idea, but when they start talking to the customers, no one buys it. So the investors want to see there are actual customers, and no one invests in an idea actually. But if the idea is not like a very brilliant one, like you are landing on moon, something of that sort, like Tesla, otherwise ideas are commonplace. How you execute is very important.
One more question is, sometime people used to focus more on facts, figures.
Mhm.
Okay,
Hmm.
these are very important.
Hmm.
But do you think that storytelling is also, how effectively you are
Yes.
communicating with the angel
Yes.
investor is also important?
So from the first slide itself, if you start building your deck around a story, and that to a personal story, then people relate to it. Because unless and until you tell people a story around your startup, why you are doing it, what motivated you to do it, people are not going to relate to numbers only. Whatever figures, whatever financials you put in, people would have lost interest by the time slide number 14 or 15 is coming on front of you. So storytelling is important. So pitch deck should be done through storytelling. If you can access some of the resources from the internet, then see how Uber's founders presented it. They always had a story to tell, that yeah, they were traveling and they couldn't get cabs, and that is something that you can relate to. Storytelling is very important.
Okay, so setting a credibility at very
Yeah,
beginning of the pitching is
because
very
that
much needed.
tells the other person that there is an actual problem that needs to be solved.
So, so we have received few more questions, but all are very specific. Like we have received one question called, yeah, designing and science, Gyanesh Rao. So, any tips for funding angel investors and VC in defense sector in India without foreign backing?
I think that is something that you will have to do specific research on. But as far as
Yes.
my knowledge goes, Lightspeed Ventures has invested into a few of the defense drone startups. So you can see and look, but they are VCs, they are not angel investors. And rest of it will have to be researched upon. Lightspeed does it, but they are VCs.
Yes. One more question is here, is there any need to give 14 financial ratios like
No, no,
debt to
no,
equity
no. You
ratio?
just have to identify what is specific for your industry and
Mhm.
what actually works for your industry. Some work for service sector, some work for manufacturing sector, some work for both. So like I said, CAC is very important, customer acquisition cost. Then talking about LTV is important, lifetime value is important. Some of the ratios, it's important. You need not put everything into your jumble, everything into your financial deck. You can identify what are the financial key matrices that you want to project in front of the investor based on your sector and based on your stage.
Okay. One last question is, difference between SAM and target market. I don't know, it's a very
Okay.
specific question.
SAM is basically serviceable addressable market, a market that actually can be serviced in your sector. Now there is a total market, right? So if you are a company in the, say, like Uber, you are giving cabs for hire, then there would be a total market that these are the people you can totally address. These could be office going people, these could be school going people, or these could be traveling people who take outstation trips, or these could be people who are actually going for some outings. So that's your total market. Serviceable is what is the market that you can address. Now you cannot address a market that's in very rural parts of India, right? So you have to find out what exactly is the market that you can actually address. So the say the total market is somewhere around, say, 1 billion. So that's the market you have in India. And these are arbitrary figures I'm talking about. So, and out of that, what is the market that you can actually service? Now you cannot service a place where there is no internet. You cannot service a place where there is no electricity. Then there is no road, and you don't even have cap players in those areas. So you have to find out that market first, what can be serviced, and out of that, what is within your reach is the target market. So say you have, say, now you have 50 lakh with you, right? So what is the market that you can achieve with that amount of money? What are your limitations? What kind of a team, how you can penetrate the market? So you cannot say you have market in Delhi, you have market in Mumbai, you have market in Kolkata, you have market in Bangalore, but you cannot address all the markets at the same time. So you do have to talk about what exactly is your target. Is the target going to be metros only? Is the target going to be tier 1 cities only, or tier 2 cities only, based on your capabilities and your capacities? That's the difference between what can be serviced and what you can actually achieve.
Thank you so much. Thank you so much for joining today and sharing very valuable information. And
I hope people have understood what I actually tried to talk to them.
yes. And I really appreciate all the viewers who have joined it. I will request all Yukti participants to kindly do watch it, all sessions. Maybe if you have missed any part of it, maybe you can, again, revisit the link and go through with it carefully. We will meet again with the next speaker on another different and unique topic. Till then, I really appreciate ma'am for joining today. And also I appreciate Amit ji and Monica for their back and support. Thank you so much, everyone. Thank you so much.
Thank you. Thanks a lot. Take